Welcome back, everyone, to another edition of Insightful Principles. My name is Kevin Jenkins, and you are now watching episode 29. And I'm so glad that you all are tuning in at this moment. In this video, I'm going to give you the 12 most common terms that you will hear in the fields of personal finance, business, and investing. Now, for those out there that may be new to learning about finance, or even for my seasoned investors, this episode is definitely for you. So let's go ahead and let's get started. So the first term that you will hear when it comes to investing is dollar cost averaging. This term is so important when it comes to your investment strategy. It's usually a strategy that a lot of beginning investors will do, or even people that work with an employer. They will continually invest their money month to month, regardless of what happens to the price. And what this does is it creates a cadence for your money being put into the market. Another benefit of it is, rather than trying to time the market, this strategy allows an investor to take advantage of the fluctuations of the market if a fund or a stock goes up or down. Now, since the stock market tends to rise over time, the goal of dollar cost averaging is to decrease the overall impact of volatility on the price of an asset, as will the price will change each time at different periods. Therefore, the investment will not highly be subject to volatility. So another term that you will hear in the field of investing, asset allocation. This is usually broken down into three areas. You have stocks, bonds, short-term debt. And for those that are watching this video for the first time, stocks is pretty much the ownership of shares within a company. It usually represents the equity of a company. And usually when you have a stock, you own a specific amount of shares within the company. Now, when it comes to debt, when it comes to bonds, bonds is a debt instrument that represents a loan made by the investor towards the borrower. And most of the time, the borrowers are either the government or either corporate companies. And the bondholders are usually paid back in either fixed or variable payments over a certain period of time. All bonds have a maturity date, and that's kind of when the bonds have, so to speak, their expiration date. That's how I kind of look at the maturity date. That's the date that the loan has to be paid back to the investor. Now, whenever you see short-term debt within asset allocation, this usually relates to debt that can be converted into cash within 3 to 12 months. So examples of that would be money market instruments, CDs that you would see within banking institutions, government bonds, or treasury bills. Now, your asset allocation is going to come down to your risk tolerance and your time horizon. And if you haven't already, I would definitely say check out episode 27. I talked a lot about time horizon and also risk tolerance with the guests I had on the show. And so you definitely want to plan accordingly when it comes to asset allocation. But this is a great way to see the pie chart of where your assets are allocated. Now, the third term is mutual funds. I know some of you may have heard of this, some may haven't. This is usually what your funds are invested in with your 401k, your 403b, your 457 plans with your employers. And it's usually an annual, it's usually a pool of money from investors that is invested into stocks and bonds. And the reason of this is to be able to spread the risk over a certain period of time. And usually a mutual fund is managed by a fund manager or a portfolio manager, and even in some cases a hedge funds manager if it's more a high net worth individual. Now, the fourth term that relates to mutual funds is expense ratios. Expense ratios are usually the cost of running your mutual fund. It's usually an annual fee that is converted into expense ratio. And really, you can look at expense ratios as the cost of being able to manage your mutual fund. It's the percentage of the fund that goes to this expense ratio for the fund managers that are managing that fund. So the higher the expense ratio, the less money you will make in that fund, and vice versa. You know, if the lower the expense ratio, the more money that you'll make. So expense ratios cover everything from administrative and record keeping fees with your mutual fund, and then also they also cover the marketing, the promotion behind the fund. Now, the fifth term is an index fund. This tends to be a popular option amongst investors because the fees tend to be a little bit lower than mutual funds for the most part. And an index is simply the collections of stocks or bonds that mirror a slice of the economy. So, for example, XLK, that is the technology sector SPDR fund that mirrors the S&P 500 technology stocks. So by tracking the performance of a stock, indexes, they give investors a sense of how well a stock or bond or a portion of it is doing. Now, the sixth term is the prospectus. This is really where most of your research is going to come in. Most brokerage firms, they do have the prospectus of all of their mutual funds, their stocks, all on their websites. And this gives you in-depth details on the stocks, bonds, or mutual funds in areas such as the portfolio holdings, the investment objective, and also the fund performance. So I want to go over some common terms that you're going to hear in business. I just went over some common terms you'll hear with investing. Now, when it comes to business, profit margin is one term that you will see and hear. I've mentioned this before, but it really measures the profitability of a company. And you would simply subtract all of your expenses from your revenue. And if the number is positive, that's your profit. If it's negative, that means that you're operating at a loss. The eighth term, return of investment, RI. This is very important for all my business owners out there, entrepreneurs. This measures how an investment performs. You calculate your RI by the company's net profit, by the total investment multiplied by 100%. So for example, if you had a $5,000 profit and you had that on a $15,000 investment, it would be a 33% total return. Tracking your ROI allows you to evaluate the performance of your investment within your business. Now, another term, this is the ninth term, is cost of goods sold. This measures the costs associated with the goods you sell within your business. So, for example, if you had a restaurant business, all of the ingredients, the condiments, that's what is required in order for you to sell your product or service. So that would be your cost of goods sold. And the difference between your sales price and your cost of goods sold determine how much you keep as profit. So the cost of goods sold and the profit margin, those do correlate with each other. So definitely make sure that you are knowing your numbers as a entrepreneur. Now, I want to wrap up the last three terms of common words that you will hear in finance. And this is going to be the 10th term. And this is fintech. Fintech, when I first heard this word, I was like, what in the heck does that mean? But fintech is pretty much financial technology. And I heard that just by listening to podcasts. Education is very important. Make sure that you are learning about these concepts whenever you hear it for the first time. And pretty much this term is used to describe how new tech seeks to enhance and automate the use of financial services. So I really look at fintech as the innovation in the way people transact business, from the invention of digital money all the way to double entry bookkeeping. So some fintech developments that have happened over the last 10 years is, of course, cryptocurrency and digital cash. Cryptocurrency is pretty much peer-to-peer transactions between two different parties without the intermediary of a bank. So it doesn't require a central server. It doesn't require the approval of a bank, and you're able to make those transactions electronically online through the blockchain technology. Now, speaking of blockchain technology, that's another development within fintech, and it is a distributed ledger technology that maintains the records on a network of computers. but it doesn't have a central server, like I said. So everything is decentralized, and definitely fintech has continued to grow within the industries of finance, and it's only going to really progress the evolution of how financial services are done within the world. So the 11th term that's most common when it comes to finance is customer acquisition costs. I had someone reach out to me that has seen my videos and asked, what exactly is customer acquisition costs? And this cost evaluates the costs associated with persuading the customer to purchase your product or your service. Now, to calculate customer acquisition costs, you would simply take the cost of all of your sales and marketing over a given period of time, and you're going to divide it by the number of customers that you acquired during that period. Now, this indicator is great with looking at how your marketing and sales dollars are converting to actual business and potential clients within your business, where you're able to really compare those numbers and see if what you're putting into your sales and marketing is giving you that output of business when it comes to lifetime customers. Now, the last term is very important in finance is IPOs. You'll hear this word a lot, especially with watching any investment television show, even on CNBC. IPOs are pretty much stands for initial public offerings. And this is the process of when a company becomes public for the first time on the stock market. So they usually start as a private company, and then when they IPO, they then become a public company, and that's when they start to issue shares. Now, companies, they usually they have to meet the requirements by the major stock exchanges, the New York Stock Exchange, and also the Securities and Exchange Commission. Now, an IPO is usually an exit strategy for the founders, such as the CEOs, the business owners, and also the private investors that are looking to realize the full profit from their private investment. Now, some great IPOs to keep on your radar that are going to IPO before the year of 2020 ends is Airbnb, which a lot of you know, Airbnb has completely disrupted the hotel industry, and they have really created an ecosystem where short-term renters are able to use these accommodations from property owners, and it also presents business opportunities for people that are looking to Airbnb their own home, apartment, and other things. So Airbnb is definitely a great company that I'm gonna have my eyes on. But I think, like with any IPO, you always want to let the dust settle, because there is a lot of private investors that are involved with these IPOs, and once they get their profit, they tend to sell their positions in some cases. So you don't want to be on the wrong end of that, where you purchase it right when it comes out and you start to lose your money right at the beginning. So it's always good to give it some time, allow it to settle, and make sure that you're doing that fundamental analysis. Another IPO is DoorDash. I mean, I use them a lot. They're a great food delivery platform that has presented a lot of opportunities, even for people that are looking to earn extra income during this pandemic. And it definitely is always been great as far as, when you don't want to cook. Being quarantined, DoorDash has been a great option to get food delivered to your door. And the last IPO that's going to be dropping before the year ends is Roblox. This is an online game platform. It's pretty much the online version of Legos, and you're able to play these games online with other users that are creating the games also as well. And it's a great platform. I see a lot of teenagers are on it, a lot of the younger generation, but this is definitely a great company as well to invest in, because I think with a lot of people being at home, a lot of parents having their kids having their schooling done at home, Roblox is a great IPO play as well. So that pretty much wraps it up for this video. I hope you all got some great insight on the 12 most common terms that you will hear in business, personal finance, and investing. Once again, my name was Kevin Jenkins. And if you all can continue to like, subscribe, and share this video, I would greatly appreciate it. Continue to share this message of financial literacy amongst your family and friends. Please support my Patreon page where I create exclusive content for all of my supporters. And I have a lot of great tiers on there, from early access to my episodes to additional content that is completely separate from my YouTube videos, and just being a way to connect with me more, be a part of my mastermind community group. So I want to thank you all so much for tuning in to another episode of Insightful Principles, and take